Excuse me. All right. All right. Good evening, traders. Happy Tuesday. Well, it wasn't a great Tuesday. It wasn't terrible. If you did the BLDR trade, we stopped out yesterday, didn't suffer through today. If you didn't do the BLDR trade, you didn't miss much. Microsoft trade looks fine. And we're actually going to break that down. And if you didn't take it, it's still viable, obviously. So we're gonna talk about that. We're gonna give it just a minute here. Um, we're gonna give it just a minute here and um see what happens here. We get anyone else? Hi Perry, good to see you. If I didn't see you yesterday, I hope you had a great Easter. If I saw you yesterday, I hope you had a great rest of your Monday. Cannot believe it's April. Time is flying. All right. Okay, I think we're in a good place. Let's get into it. Oh, and as I say that, one more trickles in. Okay, welcome out to the Market Watch Group Options Foundations 2.0. Very, very excited to be moving into the second half of this, right? It's a 2-month session. Remember that May is going to be our catch-all month. We've been talking about some things. We've been talking about going through a trading plan that's completed or more fleshed out. We've talked about going through somebody's 100 trades of record keeping when the numbers are done. We've talked about doing a random experiment of trading. That one might take a couple of days, right? There's a few of these little things that we've discussed. We will have approximately 9 Tuesdays and Thursdays in May. Is that right? One. I'm going to count them. 9. We have 9, 4 Tuesdays, 5 Thursdays. Let's decide how to use them. We have 1 month to decide. I'd like to have time to put together a slide deck just to keep myself organized. So be brainstorming. You've heard some of the ideas already. That's maybe half. That's maybe 4. What I just went through. 4. What's the other 5? Don't have to let me know now. I'm just planting that seed. So there you go. Welcome to today's presentation, Options Foundations 2.0, where we move into application mode, right? On Thursday, we went through debit spreads, the slides, what is it? What are the strikes, expirations? What am I thinking about? Today, we're just going to go into the platform. A quick review, a quick refresh, and then into the platform. Stephen, good to see you. Yes. Once you're here, we're ready to go. All right, let's get started. The disclaimers, as always, educational, illustrative purposes only. We are not advisors. We are not brokers, et cetera, et cetera. Today's agenda, we're going to do a quick review. What is a debit spread? We're going to talk about bull call spreads because we're bullish. I don't care if the market's down a little bit. It was down a little bit. We'll talk about market conditions, but we're going to focus on bull call spreads because that's what we're trading right now. And then we're going to dive into the model and we're going to find any symbols that look good. And I'll show you, right? I'm going to spend a little bit of time talking about Microsoft. It got put on as alert yesterday. The alert triggered. Today it was down, but certainly not out. So how bad is it? We'll see. Let's take a look. After the model, we'll go through a little summary, and then that will allow us to then move on to what's next in the arrangement. What's next is time spreads. What do we have left to go? We have time spreads on Thursday. We have advanced combinations. We've got implied volatility. So 1, 2, 3. We may have a freebie or two. We'll see. But that's what's coming up. Let's dive in. What is a debit spread? Quick reminder. I'm gonna even take one step back and just remind you, as always, of our building blocks. We start with options as what? Buyers. We're buyers. We have rights. And when we feel comfortable with that, then we switch gears and we say, well, let's look at it from an inverse perspective as sellers. And we say, what does that do for us? It turns things upside down. And then we say, well, what if I combine those combinations also known as spreads? And we started with just simply adding a long leg to the naked option. So what does that mean? Well, if we have a naked put or a cash secured put, doesn't matter. If I have a naked or a cash secured put and then I buy a put, I don't need anything else to cover it. The put that I buy now provides a hedge for the put that I sold. And what does that become? Well, I sold at the money, bought out of the money. So the one I sold costs more than the one that I bought. So what do I have? I have a net credit. That was a credit spread. So we started with credit spreads just as a continuation. That's the building blocks. Now we're saying, oh, well, what if we were to go back to being buyers, but instead of just buying it, we buy one, and then, so I'm buying maybe a little in the money, then I sell one. And that creates what? Well, now the one that I bought costs more than the one I sold, so I am in a debit. Still a bullish strategy. So in this case, buying the option, and we're doing a bull call because we're bullish. Buying the call is the driver of the trade, and then we sell an option simultaneously. Why? Well, selling the option is because we know that there's something about those options that either A, makes them expensive, or B, we expect our time to be longer, or C, a little bit of both. But whatever, we have an inclination towards selling. And so we sell something, buy something, net debit, but we're still looking to put time on our side. And this is again addressing one of the most common misconceptions of spreads, where people think if I do a credit spread, time's working for me. And if I do a debit spread, it's working against me. False. Time can be working for you on either one of those, and it can be working against you in either one of those. You should never make an assumption that because you have a spread, something's just automatically in your favor. That's not true. And we'll see that here in a second when we start with the Microsoft. And we'll do Microsoft first, and we'll move on to something else. Okay. Do we do both sides? Net debit is the cost of initiating the position. Remember, when you're buying something in options, that's the risk. When we're selling something, that's the gain. So whichever side we're on, we know immediately what the max risk or the max gain is. This is a debit. So whatever we pay for this is the max loss, but we're not really thinking max loss. We want to understand how much am I likely to lose at the level where I draw my line in the sand. We're going to talk about that in a second. Remember, there's two types of debit spreads. Bullish, that's a bull call. Buy the call, then sell one further out of the money. Same expiration, also a call. And then we have bear put. We will use bear put spreads. If we get into a bear market, let's say you have a market that's down 20%. That's now bear market territory. If you look at 2002, 2008, if you look at 2020, Those were our last three bear markets, right? And they all got hit for about 50 to 55% on the S&P, more on the NASDAQ. Actually, I'm thinking no. On 2020, we were only about 30, 38, I want to say. Maybe it did get lower. I'd have to go back and refresh. Anyways, down 20 in a bear market that could easily drop 50. So is there plenty of opportunity? Even if we're already down 20? Yes. But if we're already down 20, what is the implied volatility situation going to look like? Well, if you're already down 20%, the VIX is spiked. Right? I mean, we haven't seen hardly anything remotely near 20%. And we'll still see the VIX at 20, 25. By the time the VIX is down 30%, the VIX is in the 30s. What does that mean? It means buying options is going to become untenable. It's so expensive. Just very, very difficult in that regard. So yes, we will use bear put spreads in a bear market. It's going to take a while before we would do that. Early on in trading to the downside, we would be more inclined to buy puts. They're still cheap. Implied volatility swelling is going to help you. But once it's swollen to a certain point, then you've got to stop buying and start thinking about at least some component that's selling, i.e. debit spread. Okay? And real quick basis for it all, what do we need? We need to start with positive market sentiment with an expectation of rising asset prices. We're bullish. Right? We're bullish. We're positive 6. We're on the north side of 6. It's a bullish market. April is a very bullish time. We still seem to think the Fed is accommodative, and we all know the old axiom: don't fight the Fed. So yes, I would say we're starting with a bullish outlook. We're going to buy a lower strike call. That's the driver of the bullish position. That gives us the right to buy the stock. That's what's going to gain in value as things go up. Simultaneously to that, I'm going to sell a higher strike. That's going to create premium income that I'm going to use to offset the premium that I had to pay. It creates an obligation for me to sell the asset at the higher strike. However, if I'm ever forced to deliver on that obligation, that means I've reached max gain. I have no problem with that at all. The thought process here is either A, options are expensive, and we want to take that element out of the risk, out of the equation. And there's actually two components to that element. There's theta and vega. Theta is the time decay. Vega is the sensitivity to changes in implied volatility. That's the first thing, right? That's the first thing. The second thing we might be doing, we might be trying to make the options cheaper. If you're trading a $1,000 stock or something with high vol, the options are expensive. It's going to be hard to do with risk management, whereas with spreads, we can certainly accomplish that. So there's a number of reasons why we might do this. Typically, it's expensive options, meaning a high price stock. Expensive options, meaning high volatility, right? Meaning they're expensive relative to their own selves, not that they're empirically really expensive to buy. Your time frame is longer. If you have a longer time frame, you want to start to get time on your side, and this is a great way to do it. So there's a number of reasons that would have you thinking about this. And now let's go talk about it. Let's go think or swim. So let's put this on pause, and I'm going to bring up this, and I'm going to bring up this. So here's the Microsoft chart. Now you can see that even we didn't cross on the stochastics, but it did turn, right? It did turn up. Price turned up. We asked for it to cross a certain level. It did. It crossed down in here, and then it went up, and then it pulled back. And then what happened? And then today, the market pulled back a little bit, and we dropped. And you can see that at one point, we dropped even lower still. but push back up. Now, here's the thing. I see this as support right here. But when I was building the spread, I had the ability to give myself much more room. In fact, if I just pull up the alert, move this over here, and my stop isn't down until 415. Okay. 415, which is down here. Today we got as low as 417.84. Wasn't that close, right? If I had put my stop just underneath this level, I probably would have been stopped out, but I didn't. Why? I don't need to. And the reason I didn't need to is because we did a nope. There. Because I did the spread, right? Because I did the spread. Now, if you notice, I have a level down here. Let's make this bigger. Definitely throw questions at me because this is live here. So we entered around this level here. And then we pulled back a little bit. So we actually started over here. We've pulled back, and you can see that I'm actually, even right now where we are, my theta is positive. Not a lot. It's actually really more neutral. I would define that more neutral. I'm theta neutral, which means what? It means that I'm not getting hurt by time decay. If anything, I'm slightly benefiting. It's 50 cents a day. It's not much right now. Remember that all the way from here, 417.65. So let's go look at 417.65. That's down here, kind of at today's low. That's as long as we stay above that level, I'm actually making money from time. Not a lot in the beginning, but I'm making money from time. So as long as it stays above that, you'll notice that's like this old resistance, new support. Like, yeah, I feel good about that. I actually feel good about it even having to break a little bit, at least in the first week of the trade. So here's what I mean by that, right? Like this week, even if it broke down to 415, you'll notice that on 5 contracts, let's say it happens on Friday, the 5th. It's Friday the 5th? It is. On Friday, I'm only losing about 150 bucks. 150 bucks. That's it. The risk is contained. I could even give it a little bit more leeway than that. I was actually thinking more like 200 in the beginning. So I've got this trade so that if it goes against me and it's wrong, it's got to be clearly wrong. It is broken support on increased volume. Yeah, I'm out. If it just sits here for a little while and doesn't do anything, I'm going to wait because I'm bullish and because I don't have to make a decision. If I buy an option, I would have to make a decision, right? If I buy an option every day, I'm losing more and more. Here, no. Vega, volatility, I'm at an 8. So if we go look at volatility, you can see it's not low. Low is under 20. It's more high. It's not high. The highest is above 30, and we're about 26. Not low, but overall, it's not outrageously high, 20 to 30. You know, when the highest point is 33, it's not terrible. Even still, though, I thought, you know what? I think I'm going to go with this trade because A, it gives me a great reward to risk ratio here. Number 2, if it ends up taking me, let's say 10 days. So let's go out to the, what day is today? 3rd. We'll go to the 19th. You'll notice on the 19th, I'm making almost $700 Today, it's only 550. So today I'm risking about 170 to make 550. That's 3-1, better than 3-1. But if you look at the fact that if I'm right and it takes 2 weeks for me to be right, I'm actually making more like $670. My loss, at a certain point, I'm not gonna, if it starts to go up and it gets past, let's say 427, 428, at that point, I would move this to here and I would say, okay, I'm not gonna let it break 418 by much, because at this point, I'm basically at break even. As long as it doesn't stop me out, I'm gonna make money on the trade. So you can see that part of what we're doing with this trade is trying to make it a higher probability of success. It's not going to be as good of a reward to risk ratio. This one's pretty good. We're getting 3-1, possibly even closer to 4-1, but typically you're not going to get the same reward to risk ratio as you would when you're buying an option, right? So if you're buying an option, you have different considerations, but here it's a little different. Steven says, so are you closing the trade early by closing it on the 19th to make that much? I probably would in this trade, yes, because I have 445 as a pretty lucrative target, because at that point, I'm getting 4-1 on my initial investment. Remember, we're thinking somewhere between 150 and 170 of risk, and I'm at 670. That's 4-1 off of 170 of risk. So yeah, if I've made that much reward to risk, I'm going to go ahead and take it. Some people won't. They might just let it go and think, you know what, this thing might pull back. If it does, it's only going to pull back into this. It's not going to pull all the way back because now it's trending. And they may just sit on this thing and try to get closer to 80, 90% of max gain. Max gain on this is 1,100. So we'd only really be getting about 60%, right? We'd be getting about 60%. 60% is not bad. 80% better still. But you're putting your 60 at risk. I'm not looking at it as much as, you know, what percent of max am I getting? I'm looking at what percent relative to risk. How much did I risk for this trade? If I'm risking a couple hundred to make, if I'm risking 150 to 200 and I've made 650, that's better than 3-1 at any way I look at it. I'm going to take most, if not all of it. Maybe I'll leave a little piece open. So there it is. I do have an automated order on this right now. I would take it off if it looked like it was going to get stopped out on a gap down. But right now, if this thing were to drop and cross through here, I have not through here. Let's move this back down here, down at 415. If it breaks through 415, I'll shut this trade down. I'll buy it back. No, I won't buy it back because it's not a credit. This is a debit. I will sell the debit. I will sell the spread automatically. Done. I have it set up as a conditional order. I can show you even here. So this top half here, I have nope, this bottom half here. I have 5 contracts total, so I have 2 and 3. The first 2 stopping out if it drops below 415, at or below 415. The second 2 at or above 431, nice and easy, right? I'm not looking for much there. In fact, as I think about it, that's not enough. I'm actually going to change this because we got in at 424. I'm thinking I want the halfway. So I want 12. I want 436. So what I will do, this will be a great one. I'm going to cancel and replace this order. And now you can see I have this. I'm going to go this order that says to sell 2 contracts at market good till cancel. You might be thinking, can you set a market order good till cancel? Typically, no. But if I have a condition here, remember I have one condition that says if Microsoft goes at or below 415, get me out. Or if it goes at or above, and I'm going to change this to 436. I'm going to give it a little more room. So I'm going to save that, confirm and send, and you can see here's the order. I'm selling my two of my contracts at market. Am I comfortable? Am I comfortable with market orders with Microsoft? Yeah, the liquidity is off the charts, right? Very, very strong liquidity. This has to be a rule you have in your exit plan. I mean, yeah, I would say make it a rule to decide, am I going to set a hard stop, a conditional stop? 446. Did I say 446 or 445? I have 445, 446, same. I mean, right? You can definitely put that in there. So send. Oh, what did I do? I did two things here. Oh, because these are these linked? What did I do? This one is now at or below 415, at or above 436. This one at or below 415, at or okay. So we're gonna do the same thing here. Cancel replace. And we're gonna come in and make this. Oh no, that's fine. 445. Yeah, that's fine. Delete. Okay. Yeah. So what do I have? I have stops on both of them at 415. If this drops below 415, these will both sell. And I will lose tomorrow $177. Okay. Nope, that's not tomorrow. $150, right? 150 bucks. That's what I have at risk right now. I put 436. Two different orders, Stephen. Two different orders. Order number one with two contracts. Stop at 415. Target at 436. Halfway. Order number two with three contracts. Stop at 415. So they both stop at the same place. Target at 445. This one sits longer. Correct. 436, the first two will be automatically closed. 445, the other three will automatically close. All automated, right? I can change the automation at some point if I want to, but that's all automated as of now. Questions, comments, concerns? That's the Microsoft. Well, let's go find another one that looks similar to that. And let's build it. And maybe this will be an alert for tomorrow. Who knows? Who knows what we'll find? Apple. Ooh, Apple trying to hold on. We'll see if it does. AIG still setting up. That's close though. That's on the list. AMD. Actually, you technically still have a trade on this one. Just kind of holding on to it, seeing what happens. So let's take a look at that, actually. AMD. AMD was a credit spread. AMD was a credit spread. We wanted to get above 180. 175 by 180. Looks like we had a stop down at 173. And even now, if it dropped down there, we're only losing 150 bucks. This is April. This only lasts a little longer, right? This only lasts a few more weeks. So if I look at AMD and I think, okay, If this thing starts moving and breaks, breaks above this high, 187.69, 187.24. If we break above 188, I think this thing's heading on up. I would hold on to it. I would hold on to it, and this trade here would make maximum gain or close. 90%. What would 90% be? That's about $900. We're at 150 risk right now. Down here at 173.5. Do we need to even give it that much room? Yes, we do. If it bounces from here, then we can maybe move the stop just under this low. This low is 170. So maybe we move it to 174.50 if we bounce from here. Whoops. 174.50. Okay. Let's see. Right now we're risking 150. If I go to 174.50, goes to 105. Not a lot of risk. A lot of upside gain. All it has to do is what? Hold up. Hold up above this trend. It can just go sideways and just slowly, as long as it stays above 180. That's it. That's all we're asking for. If it drops down to here, we stop out, $150. If it gets up above 188, we're going to ride it to the end. We're probably going to make 80 to 90%. So yeah, I see us risking 150, 200 with the possibilities of making 750, 800, right? Great. Let's keep watching this one. Let's keep watching it. AMD, Amazon, nothing yet. The automation is my exit plan. However, if it does better, you could let it ride. I don't think I have upside automation on AMD. I'm trying to make it mirror like what we're doing. No, I don't. I don't have any upside automation on AMD. So that one's a little different. AXP, I still think is viable. I would let it pull all the way back to here, but it's not there yet. I'm definitely looking for an alert out of this though at the time. No here. No here. I'd say BLDR is actually still setting up. I might take another swing at it. Citigroup maybe starting to pull back. Caterpillar. I mean, you can see things are just kind of pausing. This looks great. CMG. Let's take a look. Maybe tomorrow if it takes out yesterday's high. Yesterday's high is 29, let's say 29.20. 29.20. So here's how I would play with something like that. Okay. So we're going to go into CMG and we're basically saying that if it breaks 29.20, we think it's turning the other way and starting to go up. Stochastics isn't great, but we could see what that looks like. And you could always wait till the open to see how it opens. Well, let's just play. If I get in there at 29.20, where's my stop? Well, definitely below the low today. 28.50, maybe even a little bit lower than that. 29.20, maybe we go 100 points. No, probably not that much. 28.30. Okay, sorry. Let me play with this a little bit. So let's say 28.30 on this side. To the upside. To the upside. Where are we headed? Well, I mean, I feel like 300 points is like a reasonable thing. We're going from 28.50, 31.50, let's just call it. 31.50. Okay. And I'm risking about 100, about 90 to get 300. So that's not bad. 3.5. Not quite. I'm going to go to May again. Am I just taking some guesses calculated for the, how do you mean? How do you mean? Well, yes, these are all guesses because we're looking into the future, right? Is that what you mean? How, I'm not sure I understand the question. How empirically? Well, I mean, if you look at what we're doing, for us to say 300 points, right? We're looking back at moves like this and this. That's empirical. So that's where this comes from. This one's not as much. So this one might have you say, hey, be careful that only moved, right? So that's empirical. Is that what you mean with the range? We're still guessing, right? But that's where the 3150 is coming from. It's a guess for sure, 100%. If you know something I don't, please pass it my way. But what we're doing is we're saying if this breaks this line, you're supposed to be working on an entry plan. Well, I'm going to talk through this and you tell me if you think this sounds like a plan to you or not. And if not, what do you mean by an entry plan? So I'm waiting for this to break above the previous day's high. So that means, let's say it opens here. Your coach says you have to follow rule A, B, C, D. Well, I mean, these are rules, right? These are, if you look at section 3 of our trading plan outline, those are trading rules that say what? What is your setup? Well, this is a setup. You can define it. Uptrend, new high, pullback. That's all there. That's empirical. Those rules are in place, right? So let's say that's rule A. What's the setup? I mean, rule A is really, how did this stock make it to your watch list in the first place, right? Strong stock, strong group, good liquidity, yada, yada. Okay, so now B. So if you're using a stochastics, well, I might say I need it to be having pulled back. I mean, you can see this was a great trade right here. So if your rule is I'm waiting for it to be oversold, you missed this trade. I feel like that's a great trade. I mean, that trade would be entering right there, and you would have made all of this and gotten out halfway up, or maybe even like to start there and the rest of it. I mean, right? I want that. So if you're going to use a rule, you've got to decide what exactly, specify it, what needs to be in place. So I'm fine if your coach says that. I'm assuming you're working with someone one-on-one now. Great, flesh that out with them. Sure, well, that's what we're talking about right now, is these types of rules. What has to happen? The buyers have to convince you that they're regaining control. How are they going to do that? Your stochastics turns up, your MACD turns up, your RSI turns up. Be careful using 3 different oscillators, because oscillators all do the same job. You got 3 guys doing the same job, telling you slightly different things. So be careful. All of which is to tell me, hey, the buyers are coming back in. We already believe they're in control empirically because we have a trend. That's it. That's part of my criteria. If it doesn't have a trend, what the hell am I looking at it for? Right? No. Well, yeah, exactly. This is great. These are the right questions, Stephen. These are the right questions. But make sure that you're thinking about this like, yeah, I want rules. Do I want dogma? No. I don't believe in dogma. I believe in rules. And sometimes rules get broken, right? And sometimes you break a rule and you get punished. And other times you break a rule and you're like, okay, rules, right? So tomorrow it breaks up like this. We want to be in the trade at this red line. So I can automate this signal if I want to, so that if as it opens and starts to go, we had a nice bullish day tomorrow. Well, I would expect this to turn up. I would expect this to go, and I'm ready to get in. I'm going to enter my trade, and then I'm going to have a stop. My stop's going to come down here somewhere. And remember that, like I did with Microsoft, I might even have the ability to say, I might move my stop here just because I can and still maintain a good reward to risk ratio, and because time is on my side, potentially. That's what we're looking at here. Now you can see that the implied volatility here is high, right? The implied volatility here is definitely high. So what are we going to do with that? Well, that's what we said. We're here because we think there's a chance this trade or whatever other trade you're looking at that does meet your rules. Your rules, if you look at when someone says your rules, they're talking about this, your trading plan, right? This or something like it. So here's my rules. What's my system? This is a bounce trade. So the name of this system would be bounce trade. And I'd say what to buy or sell? Stocks from my watch list. Oh, how do stocks make it to my watch list? Well, they have to be uptrending. They have to be high liquidity. They have to be market leaders in leading sectors. Right. So there's all these criteria that we use to just to even put them onto our watch list. We're assuming that if it's on our watch list, it meets these rules. So for me, number one, what stock or what market? Well, I'm grabbing from my watch list. Time frame. Well, you can see this is a swing trade. So we're mostly using daily charts. I might use hourly charts or 4-hour charts here or there to inform decisions, but mostly day charts. Position sizing and entries, you can see, we're going to talk about that here in a second. When to buy. Buy when you're convinced the buyers have regained control. That's it. Whatever that looks like. Is that a stochastics turning up? Great. Buyers coming back in. Is it a candle? Great. Buyers coming back in. Is it a stock? Is it the price taking out a different price? Great. I mean, it's something. That's what you're defining. What has to happen to convince you that the buyers regaining control? Bingo, bango. Yep. Should we be cautious this week? No more cautious than any other week. Because at any given time, there's something to be concerned about. So yes, but also no, meaning I'm going to keep trading the way a 6.5 tells me to trade. Okay. So we're talking about entries, then we're talking about stops. And we said our stop would be these dotted lines. We're talking about exits. And we said we're looking for it to get up top, but we might take some profits halfway up. Trade management, when would I move my stops? We've already sort of defined some of the exits. And then do we have what are our tactics? Do I want to sell 2 and 3, 1 and 4, 1 and 3? I mean, those are the considerations. And you're going to see that we're really going through most of those right now, right? So let's go back and you can see the entry trigger is here at around 29.20. The stop is going to be somewhere between 28.25 and 27.75. So we have a range down here, and the target's going to be up at 31.50. And right, these are the things that are sort of informing this trade for us. These are the exact considerations we would have gone through here when it was going down, 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 down. And on this day, someone might have been like, I don't know, it's down, but I'm bullish and I'm ready for it to turn. Just like it did back here. Now, this one didn't really do that well. We actually would have made money still, because remember, if it goes up a little bit and time is on our side, well, let's go look at what that would look like. On this trade, oh, we don't know yet. Sorry, we don't know yet. We will know soon enough, though. So what happened to my lines? Oh, I had zoomed in. Is that what it was? Okay. Well, these lines are worthless to me now. Let's get rid of them. Okay. Now what? Let's look at the trade, right? Now what? Let's look at the trade. What am I going to do with this trade? I'm just going to get something on there. So let's what are our oh geez, these options don't look great. It's because they're so expensive. Yeah, I don't think I would actually let's what oh these are so expensive. Even if I did the spread, I don't like the way that these work. Pass. We'll keep watching it just for fun. I'm gonna forget this though, and I'll be like, oh, let's look at CMG, and you'll be like, nope, the options are garbage, Scott. But maybe when it goes through the split and this thing's trading around $60 a share, then maybe there'll be a lot more trading. Why are they expensive? Um, well, it's a $2,900 stock. And so an at the money option is $6,000 for one contract. That's one at the money option because it's a $2,900 stock, right? And so the problem is you'll notice that your spreads here are 59 by 55. That's 4 points wide. Even if I get some split, if I try to build a 5 or 10 point spread, there's too much. There's too much in the spread. So, and if you look at the open interest, 13 contracts, 7 contracts, 9. That's total. I don't want to be in that type of a market. That's why. Does that make sense? Because the stock is expensive. Yes. So let's keep going. Capital One. Ooh, it's gonna be soon. Look at oil. Shit, oil just keeps going. Boo. Costco, nope. I'm not gonna let it drop like that. CrowdStrike still holding up though. Possibly. Delta's pulling back. DHI pulling back. Dow pulled back. Obviously, Ford. Okay, Fastenal. I think we still have time. We only have until the 10th. We only have until the 10th. Now, here's the thing about this. I'm expecting implied volatility to stay high. So I might still buy the options on this, even though the options are high, because I don't have any fear that the implied volatility is going to drop between now and when I would make the trade. I don't know. Let's wait and see if this one, there's not a lot of time between now and the 10th. GBTC. Oh my gosh. What just happened? Something's off because it says it's down 2%. It says down 2%, but that doesn't look down 2. That looks like it's down 30. Am I wrong? What am I missing? I jinxed it. I didn't trade it. I could have jinxed it. Let's go see real fast. I'm gonna run out of time building a trade. GE. Oh, that's it. They did a stock dividend. They complete a split into 3 companies. So what that means is they now have GE Aerospace and GE Vernova. So that means that whoever had shares got paid additional shares of the others, and the others are worth like $40. So we have GEHC, GE, and GEV now. Those are the 3, is what it looks like, right? Does that look right? So that's 174. So that's about $40 in value. Okay, so let's see GEV. Oh, that's 140, but they might not have gotten 1-for-1 shares. So it's still, that's still likely what happened. And GEHC, GE Healthcare Technology. Oh, and this is now GE Aerospace. Okay, so GE Aerospace. Very interesting. Very interesting. They need to make this adjust though, because this looks like it just got beat up, but that's not what happened. Gold, no. Google, no. Home Depot. Home Depot is just kind of getting smashed here, right? IBM, maybe. Intel, I'm a maybe. IWM, I'm still thinking about it. Oh, and here we go. Okay, so yes, I like this. The problem is the signal's valid. We can't get it for much more than it is now, right? So whatever this is, let's build Meta. Meta's perfect candidate. Nice, strong stock, held support, a little sideways, but still has a nice uptrending moving average. Held support, looking for a bounce, volatility's high. Okay, let's play with Meta. I'm gonna have to hurry. I mean, the discussions are the right discussions, but unfortunately, the market wasn't super cooperative. Let's hurry and do this though. I'm glad we had Microsoft to look at. So this is good now. Basically anything below 498, the stochastics turned, we engulfed. We're saying viable. Stop loss is going to be somewhere below this. That's at 481. So let's just go 478. That puts us at about 28 points, or about 20 points. 478 on one side. That's not what I wanted. On the other side, $535, $540. I think 540 is in the realm. Yeah, 540. Already had it there. What do you know? What do you know about that? It's only 2-to-1. It's only 2-to-1, but time's on my side. So I can live with that. Vertical. Let's just kind of start it at 490 by 500 and let's just see what happens. Okay. Now you can see what I'm doing here is I'm trying to get so that the most of, if it drops some, but not all, I'm mostly going to be positive time decay. Remember, anything above this, let me actually make this a little easier to see. Okay. So this is where we are now. Now, this is viable right now. I would want to know a week and a half from now. So let's go out to the 12th. That's how I'm going to position size this. So if I was trying to keep my position around 300, that's where I'm going to be, about $300. So I'm 2-to-1, 2-to-1 on this trade, which is about right here. I'm risking 20 points for 23 points. So about 2-to-1. Now, time, however, if I get, let's say I get 2 weeks and change. So I go out to the 19th. You can see I'm actually making about $700 on 3 risks. So I'm getting close to 2.5-to-1 because of time decay working in my favor. Yeah, this is exactly the kind of thing I like. And there is a very good chance that this would be tomorrow's alert. Something that looks like this. I've got my 2-to-1. Time is on my side. If I break out and I get above a certain level, then I have the ability to push a little bit more, right? I can always reconfigure. If I get a good move and this thing looks good and I think, you know what, I can push this a little harder. The other thing I could consider, let me just change this to April. No, doesn't work. What's the risk? Well, let's go back to May. Maximum risk, which is what's going to be held, is a little over $1,500. That's maximum risk. That's how much this trade costs. $560 a contract, $560 a contract. There's 3. My risk is only about 100 and change. So I'm only risking about 20% of the spread, right? So the capital tied up, $560 a contract. The risk per contract based on what? Based on being wrong by 478. Now, of course, if you let it go further than that or longer than that, you will lose more. But I want you to notice that even on the 19th, that's 2.5 weeks from now, we're only losing. It does go fade to negative, but it's only at $2.19. Eventually, if you watch that number right there, that number is going to ramp up. Now it's at 5. Now it's at 12. Now it's at 27, 30, 50, right? Like now it gets nasty. 80, 176. That's in May. We're only looking at this thing until April 19th. How much are we losing there? $2 a day. $2. So theta neutral here, theta positive here. And if it breaks out, then we can decide if we want to hang on to it longer. But I've got 2-to-1, high probability. That's what I'm looking for. All right. Well, we looked at one that we already got on the alerts, but is viable. If you miss the alert and you think, hey, you know what? Maybe I'll try to take it tomorrow. Yeah, it's still open. Still a viable trade. This trade here, still viable. Viable for tomorrow. Very good chance that this becomes an alert for tomorrow morning. We'll see what happens. All right. Woo! Good to see you all. I love application days. We don't get out of here before the full hour, do we? I will see everybody tomorrow morning at our midweek check-in. Thursday, we're going to start talking time spreads. Oh, I love calendar spreads. Calendars and butterflies, but right now we're in a low volatility situation. Therefore, calendar spreads will make more sense to us. Calendars and diagonals should be a good time. So join us for that. Have a great rest of your day. And as always, happy trading.